Thank you, Albert, for that presentation, and thank you everyone for joining this session. So what we are looking at today is a continuation of that income theme, and just looking at the South African listed credit market and how it's been impacted in terms of activity and pricing following the lockdowns and related to COVID-19. So what we'll cover more specifically in the agenda is obviously looking first at how the lockdowns and the outbreak of COVID-19 impacted the issuance volumes of listed credit. We're also looking at the spread migration in the secondary market of instruments that were in issue at the time the lockdowns commenced. And then we're also looking at the primary issuance in terms of where the spreads where those instruments were issued. And then we'll have a conclusion in terms of how we view credit over the next couple of months. So just starting off looking at issuance, what we've presented here is a quarterly breakdown of listed issuance volumes, and you can see there that second quarter of 2020. So in the middle of March, so the back end of the first quarter, that's when the lockdown commenced. And then obviously the second quarter of 2020 is basically when the hard lockdown and level 5 lockdown impacted the South African economy. So what you can see is that going back, let's call it more than 3 years almost, that has been the weakest quarter in terms of listed credit issuance over that period. And that really speaks to, I think, the uncertainty that was faced by all and sundry in the lockdowns and just given the state of the global economy. So, looking at these listed issues volumes, so we did start seeing a pickup towards the back end of the second quarter. June was a better month, and that's really what drove that bar. And then we saw the third quarter issuance volumes coming back quite strongly. I think, the one thing that is definitely a theme, and just looking at the monthly issuance volumes here, is again April and May being slow. But what we've seen is since the markets opened up in that first issuance in April till the end of September, 94% of issuance in the listed credit markets has been in the form of private placements. Now, in a market where there's lots of players, where there's lots of flows into these categories, these ASISA categories that is looking for credit, there is still quite a big level of demand for these assets, especially where it's your stronger issuers, your larger corporates that have weathered the COVID-19 related lockdowns better. And if you are a manager that is maybe lacking scale of some of the larger managers, the only place you really can pick up credit in volume is in the auctions. Now, with 94% of issuance being in the form of private placements, that market has really struggled to get their hands onto credit, and has probably suffered a lag in yield as a result of that. Also, interestingly, the first public auction was held in August, September. So in terms of primary issuance, there was almost, it was almost 6 months that the market went without an actual auction. Which is, again, something that we haven't seen for a very long time. Okay, so moving on from assessing the impact on the actual issuance volumes as a result of the COVID-19 related lockdowns, a question we often get from our investors is around whether that risk has been fully priced into the market. Has the credit market repriced sufficiently for the risk that we've seen? And, it's always a difficult question to answer. We do a lot of work to try and understand sort of where spreads are compared to where they were previously. But in a market that's not, let's call it, as liquid or as big and as widely traded as some of the developed credit markets, it's difficult to answer that question definitively. What we have done to try and answer that question, however, is to assess all the floating rate notes or the floating rate bonds that were in issue in the market on the 13th of March, so just before we headed into the hard lockdown, and then the instruments that are still in issue on the 21st of October. So we've excluded all instruments that have matured during that time that were in issue. And we've also excluded any new issuance. What we then looked at was to say, well, which instruments had a change in credit spread and more specifically, which instruments had a change in spread of greater than 10 basis points. So let's call it a meaningful spread change over that period, between the different lockdowns. We assess that in terms of number of instruments in issue, but also in terms of the value of those instruments per sector. Using that, we determined a weighted average spread of those floating rate notes per sector, and then tracked it through time as we moved through the different lockdown levels. Okay, so moving on, what we looked at here is just the level of repricing in the market. You can see at the top there the bank senior unsecured issuance, the bank subordinated issuance in the form of Tier 2 instruments and additional Tier 1 instruments. You can see that those are the instruments that were most widely repriced, both in terms of number and in terms of value. And that really speaks firstly to the bank senior secured instruments being probably the most liquid sector in the corporate bond market. And that's probably where people traded in and out of to create liquidity sort of in that early stage of the lockdown. It's been interesting watching the spreads on the subordinated instruments. There you have to take into account that it's not necessarily your traditional listed credit investors that invest in those instruments, but also some of your multi-asset managers that are investing in those instruments looking for yield at times when they maybe had concerns around the returns offered by the equity market. So when you had that big sell-off towards the back end of March, middle of April in government bonds as well as equity markets, a lot of those portfolios needed to liquidate these types of investments, and were comfortable, I suppose, to do so at levels that were much wider than where they were issued or where they were trading sort of in the early part of the first quarter of 2020. I mean, looking at some of the other sectors, you can also see a fair amount of repricing. The insurance subordinated instruments, again, probably similar characteristics to the bank subordinated instruments. And then you also saw quite a bit of trading in the SOC space, as well as the corporates and the property with the lease trading. But I think I think these are actually levels that are quite high compared to historical levels of spread change in the market. So I think it is reflective of a market that has been given an opportunity to reprice. So on this slide, what we've done is we've then gone and tracked that weighted average spread of the instruments that have experienced spread changes of greater than 10 basis points at any time from the middle of March to the back end of October, and just seen what that weighted average spread is. I mean, unfortunately, just given the size of the SA market and the number of instruments in issue, this exercise is difficult to do according to term or credit rating specific. So we've really done it per sector, and then just on an instrument basis. So what we've seen is, and again, this is speaking to the discussion earlier around how the instruments are held, is you saw that bank instruments across the capital structure were some of the first to reprice, sort of that mid-April, back end of March. And you can see that it actually peaked sort of towards the end of April. And I think what you see is a very interesting development is that the senior unsecured issuance, now the weighted average spread is actually lower than what it was in the middle of March. And that's something that's also reflected in the bank NCD rates, which has also come down quite aggressively. And yes, that's something that is driven by, I suppose, a lack of funding need for banks, just because there isn't a lot of lending activity, especially in the corporate space. What we have also seen, however, is that the subordinated instruments are starting to track back and are now about 50 basis points higher than where they were on an average basis in the middle of March. So probably got a bit to go, a bit of a distance to go in terms of getting back to those pre-COVID lockdown levels. Next up, what we've done is we've used that bank senior unsecured curve and just compared it to some of the other sectors. The reason we do that is because we do see banks, the bank curve as almost a floor for the majority of the corporate issuance in the South African market, and also that it's the most liquid. So there's a few interesting things here that we've done is we've excluded the property sector from the rest of the corporate sector, just because we can see that there's been a slight difference in performance of those sectors post the lockdowns. And also we've, on the SOC line, which is the blue line, we've excluded the land bank because of the event of default that occurred there. That line would have been distorted even further compared to some of the other sectors. So what you can see, again, insurance probably moving almost simultaneously to the bank line, hitting that peak with the bank line and now slowly starting to trend lower, sort of a similar route to what you would have seen on the subordinated instruments issued by the banks. And then after that, you would have seen the rest of the sector starting to move. So I think the first focus maybe from the market would have been on liquidity. And once that sort of worked its way through the system, I think you started seeing the spread widening in some of these instruments. What's interesting is on the corporate side, you can see that it looks to have peaked and it's starting to trend downwards. The two sectors that I think there is still potentially some widening to go is on the SOC sector. And again, so bear in mind, this is the floating rate notes. It is mainly the Development Bank of Southern Africa and the Industrial Development Corporation. And I think they are, unfortunately, paying for the sins of the land bank, if you want to call it that, just because I think there is a tendency towards avoiding the SOCs currently, and people are sort of are willing to take a mark-to-market loss in order to exit those positions. And the final line to maybe highlight is the yellow line, where you can see property. And again, I think those are sector-specific issues. I think there's some quality counters there, but we have seen some of the issuers actually approach note holders for changes to covenants, such as redefine and accelerate. And as you can imagine, a REIT that maybe had sort of elevated gearing levels going into lockdown that needed to sell some of its properties is now going to take longer to sell those properties, and also potentially selling them at a value that's not where they initially intended. And that could put your loan to value ratios under pressure, hence those requests. So you can see that those are sort of the industry specific concerns that the market has at the moment. So, having looked at the secondary market, we now move on to the listed credit market. And here we've tried to assess, well, what was the issuance volume or issuance level in terms of spread before the lockdown started at the latest available date, and then sort of through the lockdown and the latest and the latest issuance, how are those spreads looking? So we're starting here with the banks, where you can see sort of ABSA issuing in the back end of June at about 20 points wider than in the 5-year than what they did, or than what Nedbank issued in the middle of February this year before lockdown. But then, in line with what we saw on the secondary market spreads, ABSA achieving quite tight levels of JIBAR plus 100 basis points in the 5-year space on their senior unsecured issuance. So we haven't seen Tier 2 issuance sort of since July. So I think that's a difficult one to determine. But if you look then at additional Tier 1, again, you can see sort of the spike up to JIBAR plus 495 in August for issuance. But then two issuances back end of September and back end of October by Standard Bank and ABSA, where that spread has come back down to JIBAR plus 455, showing that potentially a peak has been reached on those spreads. The next slide looks at corporates. So you can see, just as the lockdowns commenced, there was a focus on 1-year issuance as corporates tried to manage their liquidity profile. There was some 2-year issuance as well. And corporates issuing, where they were pre-lockdown, comfortably issuing in the 5-year space. What we're seeing now is sort of issuance concentrated in that 3-year space. But we are seeing, I think, a level being held around that sort of JIBAR plus 200 level. I don't think it might be issuer specific, but it does seem that sort of some floor or some ceiling has been found in those spreads. In the REIT space, I think it's a little bit different. Again, move from 5-year to 3-year issuance. But again, there, I think the spreads are going to be very issuer specific. And I think you're going to find REITs that are sort of exposed to some of the more defensive sectors, such as logistics and let's call it the non-major retail malls, potentially having an easier time issuing. But I think we're still to see sort of a ceiling there on those spreads. So this slide is quite interesting. What we're fortunate to see is a number of issuers that have been relatively active. just pre-lockdown and also post the commencement of the lockdowns. So MTN, interesting, it was issuing comfortably in the 5-year space, pre-lockdown, sort of mid-2019. And then you can see those two issuances in the 1-year space, just after lockdown or midway through the lockdowns, where they were really focusing on managing liquidity, terming out debt maturities, etc. And what's interesting in the back end of July is to see that they were managing to place instruments again in the 3- and 5-year space, and also that the 3-year instrument is now sort of 10 points tighter than what they placed it at the end of June. So again, it looks like there seems to be that downwards trend in corporate paper. The same is being shown by Bayport, which of course is an unsecured lender, showing that they're still able to raise funding in this market and also slowly starting to get their spreads back to sort of levels that they might consider attractive for issuance. And then the final one is BNP Paribas. It's one of the first corporates to hold an auction. Here again, a corporate that issued short-dated 12-month, 18-month paper to first manage liquidity, willing to pay up for 3-year paper at JIBAR plus 190 in the middle of July. And then they came to market in the middle of October, and they actually were able to place an instrument at, let's call it 35 basis points lower than what they did 2 months prior. So, very interesting to see that it does look like a peak has been reached, especially in the high quality issuance such as BNP and MTN. So with that all being said, I suppose what is our view? I think there's two things that are or the major driver that will remain in the markets is the supply-demand dynamic that we've seen. We're going to see continued demand potentially for income-yielding assets or floating rate notes as investors continue to remain cautious. So there will be that return there will be that need for yield. Now, if you look at the bank NCD space, as I've said, it's very low, it's very tight. So if you're not deploying into credit, your returns are actually, quite harshly impacted because you've got a low JIBAR and your margin on top of JIBAR is also depressed. So there will be that demand. I think what we've seen is that it's initially come in the direction of quality issuers. And then following that, we started seeing demand for corporates and REITs that were potentially less impacted or that have recovered more quickly from the lockdowns. And so in response to that, I think we're starting to see corporates also more comfortable coming back to market, having auctions, doing private placements. I think private placements will continue to be the main source, so it might still be difficult to come by credit to build a diversified portfolio in this market. But I think there will be auctions that present itself occasionally. And if that is the case, I think you're going to see them quite well supported. And if corporates start seeing the benefits of running an auction and seeing those clearing spreads tighter than what they can do private placements, that's when you might see the corporates being comfortable to come back to the auction space en masse. Now, that being said, where do we think spreads are? As I'm giving this talk, we've got Europe going into the second stage of lockdown. We've got second and third waves all over the world of COVID. So, it's when I prepared this, I don't think all of us had we were pretty certain there wouldn't be a second lockdown. But I think it's it's a difficult time. There's a lot of uncertainty. So I think our outlook here is formed by a view that there's no hard lockdown for the second wave. If that holds, then we think the market has repriced. I think there's some exceptions. So in the SOC space, as we showed, and some of the specific REITs that are maybe more exposed to the office space. And where there is spread widening in sort of the large corporate space, the high quality space, I think those may be issuer specific, and those are risks that may be governance related, etc. And we've seen those pop up occasionally over the last few years. I think from corporate credit relative to NCDs, I think that spread relative to the NCD market is attractive at the moment. So I think you might find managers starting to go back into that credit market to harness some of that spread. That might put some downward pressure on spreads. yeah, I think if the NCD market starts to push wider again, then I think you're going to see a little bit of a risk off again as investors maybe become more comfortable to sit in that more liquid NCD space and rather not earn the yield. But I think that's something that can occur if we see sort of a very severe second wave, or we start seeing remnants of a lockdown that in what we've been through previously. I think it's also important, to close off and say, well, credit is not a risk-free asset class. There are risks involved. I think our corporate issuance market in general has held up very well. They've maintained a lot of liquidity. In many cases, they haven't required covenant waivers. There's been some amendments, but they've survived this lockdown well. I think where we are going to find challenges is if a second lockdown comes. But again, we need to compare that to sort of what is that risk then to equity returns? What is that risk to government bonds? And then we need to understand, well, where does credit fit in as an asset class? But I think where we are today, all things being equal, it does look like the market is probably reached a top in terms of credit spreads. So that brings my presentation to a close. And thank you very much for listening. Also, thank you very much for joining us for these sessions. We hope you found it insightful. If you have any questions around the presentations that were made today, please contact your regional business development managers. They will put you in touch with the relevant portfolio managers, and we'll be very happy to assist in whichever way we can. It's been a strange year, 2020. We unfortunately weren't able to meet in person at this conference, but hopefully in 2021 we'll see you again in person for the next conference. And until then, stay safe.